Welcome to the single tenant net lease investments. Again, this is been there for a long time, and a lot of our community folks, kind of is a lot of misunderstanding about the single tenant net leases. I'll introduce myself. My Hari Rao. I'm a resident of Houston. I live in Sugarland. An MBA from finance from University of Michigan. I have over 15 years of investment experience. I have done 6 multifamily investments as a limited partner. Have sponsored 3 multifamily deals, have sponsored 3 triple net deals as a sponsor. I've done many land deals. This is my portfolio. I've recently closed a couple of years back Carriage Place with $23 million deal. We also closed on Glen Oaks, which is another $15 million deal, 232 apartments. We closed in Miramar, it's 143 units. We also have some nice portfolio here, triple nets, Starbucks, which, by the way, we sold it for 51% return in 14 months. We are having a dialysis center, which is a Fresenius in Magnolia. It is about 30% unrealized gains right now. We also have 7-Eleven. And we're currently working a lot of land deals right now in Liberty Hill, as well as Burnett County, and as well as Georgetown. Whenever I say triple nets, whenever I say, hey, I have a McDonald's, I have a Starbucks, I have a Chipotle. The first response I get from people is that I don't want to make coffee, don't want to manage the burgers. I'm not here to run the business. No matter how many times I tell that to folks, McDonald's, Chipotle, Starbucks, Walmart, Walgreens, they always think about the business that's inside the building. They just can't take their mind out of that business. The fact that you own the property, not the business. Okay. And it's a difficult thing because the business is in the property. Sometimes people think that I own the business, but you do not own the business. Okay. You just own the building that has that business, and you have nothing to do with the business. And you're insulated to the macroeconomic conditions of that particular business that's been in your building. So let's run through all these different asset classes. First, this is kind of the typical chart that I show, asset classes. We all know CDs, right? You can invest in a CD and you get 0.5% today. You can invest in treasuries, short-term bond, 10-year bonds, about maybe 2 to 3%. Annuities, usually gets about 7%. And then we also have this category called triple nets or single tenant net lease. Typically, I see this as a retirement portfolio. And also people call this a generational hoards. Means once you buy these things, these are physical assets, and you can pass it on from one generation to another generation without any tax implication. Of course, we all know multifamily. We love multifamily. It's recession proof. Everybody needs a roof on their head and things like that. So we love both. So let's look at right now is triple nets. Triple nets, okay, right there. There are several advantages to it. One, you get cash flow, means you get recurring monthly, quarterly cash flow. Leverage means you can get a loan out of these buildings. This is a very hard asset. It's a building. It's not a fictitious asset. You build equity over time because you're paying mortgage. These are highly predictable. If you say 5%, it is 5%. It's not going to vary much. It is 6%, means 6%. There's a lot of predictability in single tenant tax. We'll see why. You get a lot of depreciation right off from these single tenant net leases. And you can defer the taxes on single tenant net leases. That's called 1031 exchanges. And they're scalable. Scalable means you can buy 1, you can buy 10, you can buy 100, you can buy 1,000 of those things. The risk rating for this is also very, very low compared to other class of assets. So let's go. Yeah. So what is a single tenant net lease, right? We know when we are going on the street, when Starbucks, the McDonald's, the CVS, the Walgreens, the Chipotles, the Chick-fil-A's, they're all investment grade tenants. Investment grade means what? S&P or Moody, or there are a lot of companies that give these corporations a grade of their credit worthiness. If somebody is BBB minus or above, they're called an investment grade tenant. That means they're less likely that they will default on the rents that you're getting. That's why these assets are very secure. Okay, that's what they call it. It's an investment grade tenant, and these are highly secure assets. Why we need to invest this in thing? These are safer than other investments. They earn better returns than other investments. You get a monthly income flow, cash stream. There is a very little management, zero management. You just, once you lease it, you're done pretty much. Predictable cash flow. So people, you keep getting the checks, very predictable fashion. As an investor, you're in control. And the properties are very stable, and you get very attractive tax benefits for these portfolio. And then these are prime assets. Usually they're corner lots on freeways, on very busy traffic streets. These McDonald's, these Chipotle's, these Starbucks, these Davidas, they have top-notch real estate guys who pick and choose where they need to go. They look at density, population growth, affordability, how much they can spend, how do they spend. They do a lot of demographic analysis before they pick an asset, before they pick a location. So that's why when you pick that particular asset, you are backed by their own research, basically. So their numbers will tell them that that is the place they can go and make some money. If you invest in them, that means you're making money when they are making money on top of it. Pros and cons: they're guaranteed long-term occupancy, 20 years or more. Very low risk investment there because investment grade tenant. They give a very reliable cash flow. Very little or no landlord duties and depreciation. So why would anybody buy it? The cons are that they produce a little bit lower returns than other types of investment. These are typically good for people who are 55 and older, or maybe 60 and older. I would recommend for anybody, but this ideally is suited for older population. And those who wants to invest very high dollar amounts, like a $2 million, $3 million. You don't want something to go wrong in those. If you're doing 25,000, for example, it's okay to buy a multifamily. If the multifamily defaults, it's okay. You're just losing 25,000. But if you're putting 3 million, you don't want that particular investment be under default. So you want to pick something that is very low risk. So this is ideal for somebody who's investing very top dollars, like high dollar amounts, and also somebody who is at a later stages who's looking for something more predictable. Okay. Any questions so far? I'd love to take some questions. Let's make it very interactive. And then why don't you ask some questions?
I have a question. What's the price range of these triple net properties you're talking about?
They range from a minimum of $1 million to a maximum of $30 million.
Do they need to be within the location, or does it matter?
What do you mean by location?
Like in your neighborhood, or?
It doesn't matter. It could be anywhere in the country, but it helps to be in your neighborhood. Yeah. There is always a pride factor that you own something in your backyard. When you're going for grocery, when you invest in like Costco, yeah. I own my own building.
So, and this
by
is
the way, the building that we all shop, Costco, Walmart, Sam's Club, those are all single tenant net leases. I wish I was investing, but those are high dollar amount, 20 million, 30 million, 35 million, but those are very stable single tenant net leases.
So should we be looking after like a new Walmart or Costco or Sam's?
If you can, because again, they are very high dollar amount net leases, absolutely. But if you are able to get to that stage, you can start low. You can start Taco Bell. They are usually $1.5, $2 million. You can start with a McDonald's, usually $3 million. You can start with Chick-fil-A, maybe $4 to $5 million. But these Best Buys and Walmarts and HEBs, they're pretty high net dollar amounts. Usually they're for institutional investors.
Yeah, Chick-fil-A may be a good option because everywhere I have gone, they are like long lines.
Yeah. Anybody here has any questions? Yeah, go ahead, Ram. Ask a question. Yeah.
Yeah. One other question I had was like, in case of triple net, who has to manage the roof and the building exterior, parking lot, and the other common amenities or the outside things?
Great question. You can manage yourself. Usually in a triple net structure, there is a management fee. So if you manage by yourself, you can take that money and put it in a pocket. But if you're busy, gentlemen, you can hire a management company to do that.
And
Does that answer the question?
yeah,
Yep,
Hari,
yep.
that's also depends on the lease type, right? If it is a NN lease or it depends on a NN triple net lease, right? Because in a triple net, they manage themselves.
Most triple net leases do have a management fee incorporated into their lease. Means they pay, I don't know, like in all my leases, I get about 7 to 8% of the total lease money. Like if they're saying, $10,000, usually get like out of considerable money they pay to manage my property.
Okay.
And I've chosen to hire a management company because I'm busy. I don't want to take the call at middle of the night saying my roof is leaking or parking lot is broken. They also do other jobs. They do P&L. They write invoices, let's say janitor services, cleaning services, doing window cleaning. There is a theft, the door is broken, landscaping services. They write the checks and they keep the P&L. They produce reports for you. They produce like a very professional report.
Okay. And some of the listings, they say absolute triple net and triple net. What is the absolute then? Is it something different or?
There are many types of leases. Yes, there are many types. There is a double net, means they do not pay for roof. Triple net means there is a roof. Absolute triple net means, they pay for the other hidden fees. Okay. And there is also called ground lease. Ground lease is at the top of the line. Triple net lease means you have nothing to do with the property. Basically, they don't even need, the landlord doesn't need your permission to even make modifications to the building. So you're completely disconnected from the ground lease. Basically, they can do whatever they want with those properties. So you're like completely, you don't need to go, you don't need to visit, you don't need to look at it, just close your eyes.
Is a landlord required to carry insurance?
Not on the ground lease. Triple nets, yes, but not on the ground lease. These are the different, types. McDonald's 3 cap, and we'll talk about what the cap means. 7-Eleven 4.5 cap, Chick-fil-A 5 cap, Starbucks 6 cap, DaVita 6 cap. Individual man-pass stores like a haircut guy, salon, they're like 12 cap. No, it could be even higher. Some guys. Why? Because the middle thing, right? Rating. McDonald's is AAA. 7-Eleven AAA. Maybe may not be accurately correct. This might have changed. Starbucks is BBB. DaVita's are BB minus. Not rated. Why? The risk is very low. Somebody's 7-Eleven, McDonald's, Chick-fil-A. The risk of them defaulting is extremely low. That's why the cap rates are low. That means you're buying their properties at a very high premium, and it is a good thing because you don't have to worry about it. If you are a person that you don't want to worry about it, you should just look for a low risk category. But if you want to take risks, chances, go after the what we call the mixed tenant retailers, where they can just leave with a 1 month's notice. Investment grade means, again, every Fitch, S&P, Moody's, they have grades, investment grade tenants. If it is a AAA, in a year, there is a 0% chance that guy is going to file for bankruptcy. 0% chance. Okay. If it is a CCC, within a 14-year span, it's a 41% chance that they will file for bankruptcy. So you want to stay in this range, 0.000.2, 0.01. So you want to stay in that low probability that they will default on the rents. Okay, that's why they call it investment grade tenants. If you go to the very, very back here, within 14 years, 13 years, if it is a CCC, then it's a very high risk. Doesn't mean that they will. It's just a chance. So this is a typical tenant overview. They'll say this is the tenant, this is the location, this is the number of square feet. Look at this here, BBB plus stable. Okay, they will give you the credit rating, and also they will tell you basically the number of years the lease they have. The longer the lease, the more premium you pay for the thing. The shorter the lease, the less pricey that property is. So when you're evaluating a property, you look for two things: higher the credit rating, higher the number of years that's left on the lease, the more expensive the property. Lower the credit rating, and basically lower the lease, the least expensive the property is. Got that? Everybody got that? Ram?
Yep.
Got that?
Yep.
So if it is a AAA guy, credit rating, and he's got like 100-year lease, it's going to be the most expensive property on the planet. If a guy is CCCC and only 1 month left on the lease, that's dirt cheap, okay? Because it's not worth nothing, right? He can just walk away the next day and you're going to end up paying the rent. Make sense?
No, what I was trying to say is if they had like just 1 year lease left and you buy the building and it's going to be empty after a year, I mean, how do you deal with that?
Oh, if you have a 1 year
Short-term
lease
tenant,
left on it, and if they know, they told you that they're leaving, you can of course put it in the market. That's a good way to do it. That's a good way.
Yeah.
They will let you know. You can of course put it in the market and you can release it. So this is a property thing, and there are a lot of templates like this. When I evaluate a property, there are a lot of online templates. I'll give you an IRR. Your investors will ask you, what is the IRR? What is my return if I invest in a McDonald's, if I invest in Starbucks, if I invest in Chick-fil-A, if I invest in Chipotle? You can do this cash flow analysis. Say I'm getting 83,000 rent, 83,000 rent, 80,000 rent, and I'm paying $1 million now, and this is how much I'm going to get, and I'm going to sell it at $1.7 million. Now I'm going to make 20% return. Okay, you need to do this. You need to be able to do this analysis so you can tell investors that you can give them a good cash flow. Positive cash flow. Another beautiful advantage of triple nets is leverage. If you put 30 cents, the bank will give you 70 cents. And the bank's allowed to give you the 70 cents because why? These are investment grade tenants, right? They allow these tenants. They're allowed to give you a loan because this is McDonald's. They don't like you, but they like McDonald's. They're giving the loan not because of your Ram or your Nik, because it's McDonald's. Okay, they're allowed to give you the loan on the building because there is a high credit worthy tenant in that building. That's why they love it. And then the cap rates. Okay, so everybody says, how much am I making here? Okay, this is the greatest thing on the planet. What's the bottom line, right? If the cap rates are shrinking, that means the property values are going up. So you can see here since 1990, the cap rates have been going down and down and down. Means property values are going up and up and up. Especially, look here, the last 19, 20, 21, there's been an absolute precipitous drop. Boom. It just dropped like a rock. What does that mean? Means the properties have gone up crazily. That means. You got that? Everybody got that?
What is a cap rate?
Cap rate is like an IRR. It is basically like an interest rate. It's like an APR. It's like a common denominator measure that industry has determined. It's called cap rate. It's a basically rate of return. If there is $1 million and the cap rate is 10%, that means basically you're getting 10% return for the cash that you invested in the property. So if Starbucks says cap rate is 5%, if you put everything in cash, you're only getting 5%. So it's typically McDonald's is 3%. Why is it 3%? Because it is highly secure. And if you pay full $3 million, only getting 3%. Why is so low? Because it is secure. And if you don't like it, you don't like it, right? But don't measure it by the cap rate because there are other things that will make these properties very attractive. 1031 exchange, the leverage, the predictability, the properties that are very in high trafficked areas, prime locations, those will appreciate beyond your belief. Don't get too caught up the fact that if you put 100% cash, full $1 million, you're only getting 5%. A lot of people tell me it's a grandma's return. It's really not grandma's return. It's Google-like return. I'll just show you. Cap rates is a single tenant net lease. Basically, of course, it's just saying that we reached historic lows. Means everything is very, very high. Last compared to 2020, compared to 2021, the retail has dropped -9%. Means the property values have gone up. Basically, offices they've gone down. Industrial they've gone up. Okay, this is the same thing, same recap here. In the overall net cap rates are going down. Means the property values have been appreciating over time. If you invested over here, 2010, you will be looking at a very gold mine right here, 2021, because they've been dramatically going down. And I'll show you what that means in numbers. Okay, and these are all the these are the different tenants: 7-Eleven, Advance Auto Parts, AutoZone, Bank of America, Chase, CVS, DaVita, Dollar General, Family Dollar, FedEx, Fresenius, McDonald's, O'Reilly Auto Parts. You can see since 2005, they keep returning phenomenal returns to the investors. Means if it is 6, it is 4.9. If it is 7, what does that mean in terms of return? It is pretty significant. It is pretty significant that the way you're going to do is you just have to run your math. I bought it at $1 million. Now is at, maybe, 1.52. I only put 30 cents. I borrowed 70 cents. Already got my cash flow. And it is predictable. I'm not putting much time into this thing. What is the overall return? I'm just going to show you some use cases. This is something that we purchased, okay, 14 months back, okay, for $1.4 million. We sold it for 1.9 million for 4.75 cap. Okay, what does that mean? What does that mean? Right here, 51% return. 51% return in 14 months. Why? A lot of the concept that I told you. One, loan. Two, the cap rates have to be in your favor. They need to keep going down. Okay. 3, the cash flow that the property is producing. That this property was producing 87,000 every year, and then when your rate jumps, the cap rates also jump. Okay, and also you have to go to the particular tenant and say, can you extend this lease? When the lease jumps, can you extend the lease? The property values also goes up, and the loan on this property is very low. I mean, they usually banks give you pretty good decent loan amounts. So overall, we were able to achieve a return of 51% on these properties. Total return in a matter of 14 months. And then typical properties will look like this. It's a single tenant. They will have a drive-through around it, and you will see a NASDAQ ticker symbol like this, and they'll tell you year over year, what is the credit rating for this particular location and how many years left on the lease, and you have to do your calculations and math. Okay, basically this is what it tells you: number of years on the lease, number of years on the lease. There's a triple net, double net, absolute triple net. When the lease commences, when the lease expires, you just have to run your math and then figure out the calculators. This is a use case. One of the Starbucks.
I have a question. I mean, what was the criteria for flipping this one?
When you meet your investment return, basically, when you just call a realtor and then say, hey, how can you sell this for? Well, I can sell you for 2 million. I paid 1.5. I'm getting 500,000 in a matter of few months. Hey, I met my investment return. I'm get out. And also, I kind of know. I mean, you have to look at the macroeconomic variables. Interest rates are coming down and down and down. There is only way they can go up, up, up. So when interest rates goes up, the property values go down. So.
Do you foresee that as a risk in investing in triple net right now? Do you think the interest rates are going to go up and may put downward pressure?
We thought so, but the Fed has said that they will hold the interest rate stable for the next 4 or 5 years. But if interest rates were to go dramatically higher, yes. But Fed has indicated that they're going to hold them stable for the next foreseeable future. I mean, if it goes up, again, you have to look at a lot of macroeconomic indicators. The economy has to, heat up really, really, really hard. Of course, they'll be forced to rise interest rates, and then you can tell. Actually, you can tell right here, right? You can tell right here. These were the time when the cap rates went up. Okay, why? Why? You know why, right? 2009, 2010, we're in a financial crisis, right? It was a higher interest rate period, right? And then we hit the financial crisis, and then the Fed dropped it to 0, and then the cap rates keep going down and down and down. Okay, so this time was not a bad time because it was a time where the interest rates, economy was overheating, interest rates going up. But then when the financial crisis hit, the rates started dropping. But yeah, there is always a risk of rates going too fast too soon, and what that means is the cost to borrow will go higher. That means the property's values will, or cap rates will actually go up, not down. What that means is that the properties will go the opposite direction. So, but yeah, but I mean, in a nutshell, I wouldn't worry too much. I mean, in the long term, let's say invest in 2004, right? Looking at a pretty good return from here to here, right? Even if you ignore this particular up. Okay, if you invested here, you're looking at a pretty good return. If you invested here, if you go to pretty good. Can you mute, please? Thank you. So yeah, I mean, it depends. Okay, Any questions? I mean, the overall last this quarter, first quarter 2021 has been a phenomenal year for triple nets. Every single property that we purchased or we looked at appreciated tremendously. There is a real shortage of these high value assets in the market. We have 4 or 5 properties. We get unsolicited offers. Sell me your properties, just like your house. Sell me your property. I want to pay top dollars. And then people misunderstand these properties as being a very low return properties. But if you add all these things up, right? If you add cash flow, means you're actually getting money in your pocket. You're getting a loan, very easy loan, hard asset, depreciation. You get a very big depreciation. Okay, you can defer the taxes. You can buy any number of properties that you want. Given all these things, yeah, it makes it a very, very attractive asset. And I'm going to say, a lot of multifamily lovers, what is the difference between this and this? Multifamily, you're betting on the person who manages the multifamily. You're betting that that person is going to deliver for you. What if he does not? In here, you're removing the risk of the manager managing the property. Everybody get that?
Yes. I have a question. If somebody is coming and asking you, we want to buy your property, are they seeing something in the future that maybe you're not aware of?
I did not get that.
No, they expect the property to be potentially more valuable in the future if they want to come and buy property from you. So are they aware of some information that maybe we are not looking at?
Yeah, possible. I mean, the best way to do research is that is the brand value going to go up in few years, right? Let's say you buy Racetrack or you buy QT, right? They are like subpar brands, but if they are putting a lot of money in improving the brand image, that means their value or the property in which they are today will go up in future. So you necessarily don't have to buy a McDonald's, buy something that is emerging. Maybe, Chick-fil-A maybe 4 years back.
Yeah.
Maybe Chipotle maybe 4 or 5 years back. There was an emerging brands.
Yeah.
Maybe Louisiana Kitchen. Wendy's is doing very well. So pick some emerging brands, put your money in there. They come at a very cheap price, and you can make money few years later.
I didn't see gas stations. Are they a different branch of?
It's in there. Gas stations are here.
Oh, okay.
Basically, they are associated with their name brand. Basically, like here, 7-Eleven. Okay. Yeah. So it's not like it depends on who's. Is it 7-Eleven? Is it QT? Is it a Racetrack? A Racetrack it's a gas station.
Okay.
7-Eleven is a gas station. So it depends on their brand. And their credit rating and their default risk. Actually, for gas stations, right now, 7-Eleven is like the number one property that you can buy because they're considered very lowest risk. And usually they're corporate stores, not lease stores. They're corporates. You should buy corporate 7-Eleven stores, corporate McDonald's, corporate Chick-fil-A, corporate Starbucks, corporate Davidas, corporate Racetracks, and things, because they have a very less likelihood that they will default. And then let's say you retiring 65 and you made $3 million, and it's very easy. I mean, just throw it into one of these things and just go to Bahamas. You're done. One single large asset.
Yeah.
And then you can just passing on. Once you're gone from this world, you can pass it on to many generations.
Yeah.
Tax free. Why? Because you pay tax only if you sell it. You don't pay tax if you don't sell it.
I see. Yeah.
So it just keeps accumulating, and once somebody needs money, they'll just cash it out. Okay, I'd like to take more questions. I mean, just to recap here, of all the things, I think the triple nets, multifamily, both are pretty identical. One has a management risk, another one does not have a management risk. Again, cash flow, leverage, hard asset, equity building, predictable depreciation, stock action, scalability. Okay. Pros and cons. Again, the cons is low earnings. There's a lot of upside to it. You're owning well-known brands. You need to know the basic concepts, investment grade, triple nets, lease structure. You should be able to kind of evaluate those things, being able to do IRR, component IRR, understand these cons, understand the cap rate, understand the interest rates. And anybody can jump into these things. Anybody can make, good money. I mean, this is a long-term play, but I mean, it doesn't matter if you invested here, you could still sell here and make a good money, even though they went up for, for a little period. This starting from 2004 to 2020. It's a long period.
So
overall, you can see that retail has done really well compared to office or industrial.
Sorry,
and
I had a
not
question.
one brand disappointed, not one brand. You can see every single brand appreciated.
So Hari, I was going to ask on your, on your slide where you were saying the triple net lease gives you like 15% return. Is that based on like cash on cash return on there? I think whenever
this is just an average. This is just an average. I mean, just like, typical people ask me, what is the return on the land? It's 15%. Let's say historical averages. These are like,
okay.
It doesn't mean that that's what you're going to get. You could get lower than that, or you could get higher than that. But all my properties, like in the last couple of years, like for example, this property, 51% we realized again 14 months, 51%. And then we have a couple of properties that in few months they appreciated 30 to 40%, and we get like a ton of unsolicited offers. We own a couple of dialysis centers and 7-Elevens, and we get unsolicited offers for those things because there isn't enough high quality asset.
Hi, this is Ramesh, and I have maybe one or two questions. Basically, right now, even though Fed says that there's no immediate interest hike, but there will be. That's one thing. And another thing is already properties appreciated last 2 years very high, historically high. So what do you think about next 3 to 5 years? What happens, especially this triple net, because we are already paying a very low cap rate right now. That means interest rates goes up, cap rates, again, there's a risk already. What do you think about it?
Yeah, the Fed is saying they'll hold the rates steady. So even if
not too long,
regardless,
though.
regardless of the cap rates, regardless of the interest rates, right? One thing to keep in mind that these properties produce cash flow. Okay. Regardless, the value can go up, the value can go down, but these properties continue to produce cash flow for you. Okay. Take a long-term approach. Don't look at 1 year horizon, 2 year horizon, 3 year horizon. Look at 30-year horizon. Okay. You're going to do very well. This is not stocks. These are not bonds. You can't look at just 1 year. I'm going to buy today, I'm going to sell tomorrow. Okay. You got to have a very, very long-term perspective on these things because they're dependent on macroeconomic conditions. So, but if you hold it long enough, they will produce good appreciation. Regardless, even if it is a Great Depression, these properties will produce reliable cash flows for you.
Is there a way to defer the cash flow to avoid taxes if we don't need it?
No, they will pay. I mean, it's just, they will just pay. It's a rent. You getting the rent. I think the other way to do is just have like a multifamily. I think just invest that to get more depreciation.
Mm-hmm. What is the typical time frame from the time you look at the property to the time you start getting the checks?
Typically, the due diligence period is about 3 months. And then you'll take another month to close. 4 to 5 months, you should be, getting some good, cash flows. I mean, it doesn't take a lot. I mean, I know everybody is like easily $1.5 to $2 million net worth. Let's say you have a $2 million. You can pick up Dollar General. You can pick up any of the dollar stores, 100% cash, and you should be getting $100,000 in cash flow every year. I mean, that's a good money to retire. Or good pocket money, good money that you don't have to worry about working.
Typically, what percentage is the investment versus the loan?
70-30, 70-30, but some properties, they will give you 80-20. Depends. 70-30 is the norm. And they're very easy loans. Easy loan means they don't look much at your credit. It's all based on the tenant's credit, not your credit. And these are all non-recourse, means non-recourse loan means you don't have to worry about, you can sign 10 of these, 20 of these deals. That means the property itself is the guarantor for the loan.
So Hari, you're saying this is, I mean, right now, this is Vinod, quick question. So right now it's pretty much a seller's market, right? I mean, it's in terms of retire and everything. Do you think it's a good time to?
Right now, yeah, it is seller's market. But again, yeah, I mean, if you're, looking for a short-term flip, yeah, not a good time to buy. Obviously, 2 years, back would have been a good time to buy. Same thing with single family. But if you have a longer-term horizon, doesn't hurt to pick up a few. With that said, I'm not saying invest now. I mean, you can wait for the opportunity and invest. This is an educational session. This is not to kind of to make a move and a buy now kind of a thing, right? So just to get
yeah, totally. Yeah, I mean, I wanted to do the triple nets, but never did it because how do you find the proper deals, right? Soliciting proper deals. That's one.
Yeah, you can look at the chart. I mean, yeah, you're right. The properties are the most expensive ever. You can see right there. Right? This is going down means properties are going up values.
Yes. Yeah. Yeah. And then finding the deals, like, what do you recommend in terms of, do you have to network with any of the commercial realtors or any websites or?
Yeah, there are many REO sessions in Houston. Just go to those informational sessions. A lot of sessions where they will give you a lot of good information. So and then network with the realtors. Obviously, keep looking at the deals. Get into the emails that you get. Like you can ask a realtor to give you some alerts if certain criteria were to be met. I want in Houston, I want in Pasadena, I want in Katy, I want Starbucks, I want McDonald's, I want to look at this cap rate, I want this. Give them criteria. And you don't have to make a move right away. Just keep watching it.
Got it. And then in your portfolio, right, Hari, I think the one you showed the sample, you have some of the commercials as well as you have most multifamilies too, right?
Yeah, I've done, I've actually, these are all my sponsor deals, not investor deals. I sponsored as a general partner, Carriage Place, $23 million deal, 273 units. I sponsored Glen Oaks. I also bring apartments investments to the community, $15 million deal. All of these, the ones we spend quite a bit of time doing due diligence and doing, all of them are doing phenomenally well. But for some investors, they ask for, like proud, I'm like, they want to be proud of their investments. Oh, I buy, Starbucks around the corner. Oh, I'm helping people get cured. Oh, I pump in the gas station. I want to own that. So it's some of these things are, pride moments. I own those corner lots. So we added triple nets as well. And we added quite a few. I mean, right now we're doing land deals, quite a few. Lands are very popular. So we're doing one in Liberty Hill, $10 million deal. We just closed it. I think we're just gonna get our return investors very, very beautiful returns pretty soon on these deals. These are, this is another one ranch, another one agriculture land. We're doing 3 deals ongoing, and I will give you my email if you are interested. Notepad. Take down my number.
Totally, yeah. I mean, in Austin, I think pretty much nowadays many people are sponsoring land deals in Austin. I live in Austin, so yeah. Yeah, please
ping me, and if I see some good land deals, I can send it to you. If I see some good apartment deals, we're planning to bring one pretty soon to the market. Again, it's tough to find the deals, but we are looking. So, I mean, we're not crazily bringing the deals to the market, but we're looking.
I've got a question. With increasing interest rates, you said the property values may go down, and what kind of effect that's going to have on the returns and the investment?
Yeah, absolutely. Interest rates have inversely proportional link to the property cap rates and to the property values, but not substantially. But yes, definitely they will see some impact the values. But as I said, yeah, have a long horizon. You will get cash flows at some point. You will have an opportunity, just like this month or this quarter, where the cap rates came down dramatically, and you can exit. Look for an opportunity. Buy at any point. Look for a good opportunity to exit.
Well, if you exit, what do you do with the money?
You do 1031. Basically, it means you park the money, you move it into a different asset class.
I see.
You can buy a house, you can put it in a land deals. A lot of people move their money from triple net lands to triple net multifamily. They move things around their money.
What's the tax rate on this?
It's the same capital gains. Capital gains, short-term capital gains, long-term capital gains, 15% you pay if you do make good money. Okay. Yeah, that's all I have. Good discussion. I think I love to bring more. I mean, I bought Austin deals, Austin information about Austin webinars quite a bit. And then now I think next one is going to be on multifamily. So stay tuned, and thank you for joining today. Take my email down, take my phone number down, and and then just register on that Google link. And if any new investment comes, we'll definitely send you.